Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. Now, everybody's aware of what's in the news, and that's what we're going to be discussing this week. The Middle East conflict has certainly escalated. We have a full war, and that is causing oil prices to spike significantly. Let's discuss how that's impacting various parts of the capital markets and what to expect going forward. Also, higher for longer rate expectations are certainly back. Let's take a look at expectations for the Federal Reserve and what they might do with the Fed funds rate through the end of 2026, given the large spike in oil prices. And finally, we have seen a significant shift from pre-war performance in 2026 to post-war performance during the past few weeks. Market leadership has flipped since this conflict. Now, let's take a look at this first chart here. In the Middle East, we have seen obviously the US attack Iran in late February. And since that time, oil prices have surged significantly. In fact, Brent crude, the price per barrel, is trading around $100. It was below $70 just a few weeks ago. You can see also on this chart, the S&P 500 has declined only about 4% off of its high there back in January. So we have definitively seen oil prices cause volatility across several parts of the market, but right now we are still only about 4% off that high. Now, higher for longer rate expectations are back in a significant way since the oil prices have spiked and since the conflict has started. We have seen, number one, interest rates on the short end of the curve increase and interest rates on the long end of the curve increase. Specifically, when we look at rate expectations for the Fed in terms of what they're going to do, remember the Fed funds rate is currently 3.5 to 3.75% target range, and they are in this sort of pause period. And Kevin Warsh, the new chairman, will replace Powell in May. And boy, does he have something on his plate to take over during the second half of the year. On this chart here, the target rate probability for the Fed meeting in December of 2026. So at the last Fed meeting, where does the market expect the Fed funds rate to be? And you can see this is a chart that shows the probability that the Fed funds rate will be exactly where it is right now, that 3.5 to 3.75%. Another way to interpret this chart is this is the probability that the Fed will not cut rates or increase rates by the end of 2026. And you can see just a few weeks ago, the odds of the Fed not cutting or doing anything was less than 4%. And since the war has escalated, the odds of the Fed not doing anything and keeping the Fed funds rate at 3.5 to 3.75% is nearly 50%. So the market is now pricing in somewhere between 0 and 1 rate cut by the Fed in 2026, significantly down from just about a month ago when there was a discussion, is it going to be 2, is it going to be 3? And so overall, oil causing perhaps inflation to move higher in the next few months. The longer this lasts, the more likely the market believes the Fed is going to be patient about interest rates and perhaps keep them higher for longer. Now, looking at this market leadership, pre-war and post-war. Now, pre-war on this chart is going to be defined by December 31st of 2025 up through February 25th, 2026. Remember, in the weekend after the 25th is when US attacked Iran. And so post-war returns will be from that Friday's close up through March 12th of this week. And take a look. We've broken it down into several different areas here. US large cap equity, equal weight equity, small caps, mid caps. Take a look at developed ex-US, so developed international, outside the US countries, mostly Japan, Germany, West Europe, things like that. And then emerging markets. And on the right side of the chart, we're showing fixed income, investment grade, high yield, emerging markets debt. And then the big one that jumps out is obviously oil prices. So you can see pre-war 2026, the market was actually off to a really good start and it wasn't actually led by the S&P 500, the Mag 7. In fact, those were pulling back. You can see the S&P 500 was up 1.6%. The equal weight S&P 500 was actually up 6.3%, and the market was being led by small caps and mid cap stocks, and even emerging markets and international was doing really well. So it was really a cyclical, pro risk, pro-cyclical rally, and we saw market breadth that was really wide and really strong, and the market was on really solid footing. And we can see a complete rotation out of that since this conflict has begun. You can actually see now the defensive S&P 500 is holding up the best in terms of large cap value and large cap areas of that market. Even tech is holding up somewhat well. You're seeing small caps and mid caps take the brunt of the damage on this sell-off, and international is also selling off really hard, obviously, as the conflict is impacting those areas that are commodity dependent, as well as, for example, Iran and Saudi Arabia, and those areas that are in that EM space. And what's interesting also is fixed income is not acting as a safe haven at all. You can actually see investment grade since this war has begun has actually underperformed high yield, even though underperformed high yield since this started because of that massive increase in interest rates related to those expectations of rates staying higher around inflation. So when there's expectations of higher inflation, you're going to see rates move higher. Again, moving rates higher puts a downward pressure on prices on bonds. So we're actually seeing bonds underperform, equities underperforming, and oil is really the only place to be. So we're seeing basically pre-war, pro-cyclical, pro-risk, broad market breadth, pro-international. Since the conflict has begun, obviously oil prices are surging dramatically, up 41% during the start of March here the past couple weeks. And really, the only thing that's really strong is the defensive areas of the stock market, large cap, safer blue chip companies, and oil prices and commodities and inflation hedges. And bonds are not working as a safety haven right now because of that upward pressure on rates. And we'll see how this unfolds. A shift away from this, a reopening of the Strait of Hormuz could change this leadership again because the market was on a good solid footing before this conflict started. Now, all this talk about inflation, I think it lends itself to a reminder that Costco, the classic, I don't know if all of you are familiar with this. I'm sure certainly some of you are. At Costco, they sell a pretty sizable hot dog and a soda for a combo of $1.50. Why is this important? Well, that $1.50 cost, or that price of $1.50, has been the same since 1985. They have not changed it. If you do some inflation adjusted calculations, it should likely be above $4 for that meal. The CEO was famous for saying a quote to one of his presidents after he had sort of retired that said, "Hey, if you ever change that price, I'm going to kill you." So it is certainly part of their brand identity, sort of a marketing ploy, if you will. But $1.50 hot dog and soda, if you're looking for a way to combat inflation, this might be one tool to keep in your arsenal. With that, I want to thank everyone for watching, and I'll see you next time.